Hello, everyone. I thought I would share with you very interesting information that I received recently. As you can see here on screen, I was an attendee at an event called QuestCon. And QuestCon, as the name implies, is done by this group called Quest Trust, which is a self-directed IRA entity that helps investors invest their self-directed IRA funds, specifically specialized in real estate and notes. And so they have a 2-day paid event that occurred very recently, and I attended both days, all day. And of all of the presentations and panels and so forth that I attended, the one that really caught my eye was done by Eddie Speed. It was in the late morning of the second day. Now, Eddie Speed is somebody that I'm a big fan of Eddie. He's got a lot of deep experience in notes and note investing. In fact, probably over the past 30 years, I'd say he's probably purchased about 40,000 notes, worth about $500 million. So he does know a thing or two about notes, and he gave an interesting presentation. I spoke to him on Friday, and I said, I really liked your presentation. I'd like to share with my team the information that you shared, or at least inspired by the information that you shared. And he said, sure, by all means. So this is inspired by Eddie Speed, and I will also call out some of the specific places that I got the most inspiration. Now, Eddie's presentation was actually called The Market Behind the Mask. But whatever it may be, there are some things that are going on right now in the real estate market that we all recognize seem great, seem wonderful, seem amazing, and some other things that make you go, I wonder. And so there are these good things, and there are these bad things, and of course all of us are wondering what's coming next. Now, some of you know that I spent quite a number of years living in Asia. I lived in Asia for 7 years, and so I'm influenced somewhat by that. So it's very interesting when you take a look at this kanji character on screen, which is the kanji character for crisis. We are in a crisis, is it not? And the kanji character for crisis is actually composed of two other characters. The character, as you see on the left, for danger, and the character on the right for opportunity. Isn't that interesting? So, is it not true that in every crisis there is embedded in it an opportunity? Very insightful. And so, indeed, this is one of the things that Eddie was saying as well, is that, whenever there's kind of like a crease in the market, or something happening where some part of the market is being underserved, that seems to always be the time that opens up opportunities for us who are entrepreneurs, who are investors. Most investors will recall that most of the money they made was during times of crisis. And so it's a time for us to be leaning forward, but leaning forward not just to read the headlines, but to search below the headlines and see what's really going on there. So let's start with the headlines, the good stuff, right? So we all know, we don't need to be told 1,000 times, quote, the market is on fire. It's amazing. And, you can see that first began right about when you would expect COVID to kick that off. I mean, why COVID is doing this, that's a whole nother topic. Money being pumped into the economy, among other reasons. And then continuing on through January, and then finally, for the most recent data that I have available, hitting a new high in February at 15.8. This is year-on-year percent change in median price for existing homes. Isn't that something? So, you know, uh, the question is, are we going to be able to ride this rocket into the sky? Are we going to continue to be able to ride this rocket all the way to the moon? I think you can tell by the way I'm asking this question that I'm a little bit suspicious of that. In fact, just to give you an example, most of my activity is in the area of notes, as you can well imagine, but I do invest in hard real estate in about 3 zip codes in Tucson. Okay, so December, I bought an empty lot for $46,000, and I just closed on that lot yesterday. No, 4 days ago for $85,000. I didn't do anything to the lot. The only thing that I did, well, it did add a lot of value, is I got a plan for a duplex approved to be on the lot. The utilities all worked out. A contractor quote, so it's like a turnkey. Okay, so I did add some value. But anyway, it's funny how the market is putting wind underneath all of our wings, isn't it? Now, let's take a look also at the shape of this market that we're in. So here is the distribution of sales by price range, and you can see definitely that the bulk of the market, is it not, is that 100,000 to $500,000 range. That's really where the market is sitting right now. And so you add those two, the 31 and the 40, and that's 71% of the market right now. So, but behind this distribution is a trend, is a shift that's pushing these bars from the top down to the bottom. Let's take a look at the change in the percentage from year on year. So there's those same two bars that we saw before, adding 31 and 40, adding to 71%, right? That same group. Those are the blue bars. But I've added now the purple bars showing the percent change from last year. So of the counts of houses sold in the previous year to this year. And so you can see that the houses below 100,000 are down by 25, almost 26% year on year. That's going to disappear eventually. There won't even be a category. And then, you can see that the next group up, which was one of our two main groups, right? It's down 10, almost 11%. And then, the next group up, okay, that's up, 16%. And as you walk up this ladder in price, each of those buckets are growing at a higher rate than the previous bucket. So you can just imagine what this distribution will look like 2 years from now, 3 years from now, and so forth. So that's interesting. So all of this stuff is like good, right? This is all the good, the good, the good. And indeed, with all these people making overprice offers, here you can see Eddie again. This is something that Eddie pulled from the news, and I thought it was pretty interesting, of course, relating to California. But the boom in real estate being driven at least in part by FOMO, fear of missing out. And as Eddie rightfully noted, that sounds a little bit emotional, doesn't it? So, all of that is good, and again, all of us are sitting here watching, investing in various ways, or thinking about what our next investment should be, and we're wondering, when will this rocket stop arcing towards the sky? And what will happen then? So there are some underlying pieces of information that I would like to explore with you now. Some of the things that make all of us go, huh? So again, this is a news article that Eddie shared. I attribute it to him to pull this, but this isn't really, as he pointed out, this isn't news to us, right? Just the fact that the Wall Street Journal says it gives it some, quote, legitimacy, but those of us who have been in real active real estate investors have long since noticed that mortgage availability is becoming a problem. Let's take a look at that from a data standpoint. So here's some data from Atom Data Solutions, and you can see that the trend. This is flipping profits. The You can see the average gross profit per flip is kind of drifting upwards, right? But look at that line. That's your average ROI per flip. So if the ROI per flip is under pressure, and under pressure, probably it hasn't been that low if you read it across since, I don't know, where are we? 2011, 2012, the last time it was that low. That means that we investors are having to pay too much. Oh, that's not news. We all know we're having to pay more and more too much for the flips that we're trying to do. Okay, and let's take a look at another view of the same kind of underlying situation here. We can see the Mortgage Bankers Association data, and this is an index. It's the Mortgage Credit Availability Index level by month. Look at this trend going up and up and up, and all of a sudden it's down. And of course that happened right about when COVID hit, right? So yes, it's trending up a little bit here, but in general, it's down by about 35% versus the December benchmark. So that is to say that 35% of the perfectly good borrowers that could have gotten a conventional loan at the end of 2019 cannot do so now. Think about what we were talking about: underserved markets, creases in the marketplace, creating opportunities. So let's file that thought. And let's look at this from another standpoint. So down payments are way up. So here we see that the average loan to value on conventional mortgages today, according to Ellie Mae, which processes quite a few mortgages, their sample showing 81%. So expressed another way, the average down payment is already up to about 19%. Imagine. We're not talking 5, we're not talking 10. 19% average down payment. So while the headlines and the cocktail party talk is like, look at this, real estate is amazing, this is great, prices are going up, people are paying more than the asking price in a matter of hours. Meanwhile, some smart money is constricting the amount that they're willing to lend by a lot and asking for a lot more down. Somebody that's smart has got a different view of this marketplace than the people that we're bumping into at cocktail parties, isn't it? And so, whenever there's a gap in the marketplace, there is this huge underserved market that needs to or would much prefer to own a house rather than to rent a house. Say back in 1980 or whatever, what was the interest rate back then? Something like 20%. So that's kind of about when alternative financing got started. And the problem then was that interest rates were too high. Loans were available, but they were just too high. Now the interest rates are great. I mean, you can get, 2.875, buying your home if you fit this into this box. But the loans aren't available. Either way, whenever there's a gap in the marketplace, alternative financing is what fills that gap up. So that's one of the opportunities that I think all of us want to be exploring together, is how can we step in and fill that gap, whether it to be on the houses that we're building or rehabbing or thinking about buying and somehow reselling. So That's a thing. And of course, all of us, you've all been exposed to all my information. I've got videos there on the Glastonbury Thorn website, and you all get this and you know about this. That these the opportunity to buy notes versus rentals or rehabs. All of that long list of expenses that we have if we have rentals. The vacancy, the property taxes, the insurance, maintenance reserve, and so forth, all of that stuff. When you match a note up to a rental, the net return on the note is better than it is on a rental. But in addition to that, there's this new factor. I'm in the process of buying properties that I've already have a signed agreement that I can't buy because the seller can't they can't collect the rent on the properties, and they can't evict the person either. Huh. This is creating a crisis. Not everybody has got the cash reserves to be sitting on rental properties that aren't performing, and they can't evict the tenant. So this is something that is really going to create problems, but we all want to be standing by and ready, because at the same time, these are opportunities for those who have cash available. So that's basically it. I wanted to just share with you that presentation. It really struck a chord with me. The fact is that we've got all this bubbly news, but underneath the surface there are some things that are wrong, and those things that are wrong in the terms of a crisis contain both danger and opportunity. And let's continue to watch together to make sure that we're identifying appropriately where those opportunities lie. Alrighty, thanks everyone, and I'll talk to you later.